$105 billion. That is the guarantee Nvidia just filed with the SEC, co-signing the rent for its own biggest customer, OpenAI. Today, 4 crypto stories, 3 macro, 3 AI, and at the end, who actually pays if the biggest bet in AI goes wrong. Let's run the timeline. A fund died, the ETF bid went missing, and Europe just locked the doors. 1. The first US spot. Bitcoin ETF ever to shut down traded for the last time Monday. Hashdex's fund, ticker DEFI, held just $14.5 million. At a 0.25% fee, that earns about $26,000 a year, not enough to pay the auditors. BlackRock's IBIT charges the exact same fee and holds $47.5 billion, roughly 3,000 times the size. Same product, same price. Only one of them survives. In the ETF business, scale is not an advantage. It is the entire business. 2. The money that carried Bitcoin's bull run is walking out. U.S. spot Bitcoin ETFs bled $385 million last week, the biggest outflow in 6 weeks. Per Bloomberg, Fidelity led the exits. Even BlackRock's fund lost money on the week. Bitcoin sits around $63,000, down 46% this year, roughly half its October high. The week before, the same funds took in $865 million. That is not conviction either way. That is a market arguing with itself about where the bottom is. 3. Europe's crypto law just showed its teeth. 6 weeks after MiCA enforcement kicked in, more than 1,700 unlicensed platforms have halted EU service. Around 10 million users have to move their money, and regulators are now warning that scammers got there first with fake migration emails impersonating the exiting platforms. Follow the incentive. The licensed few inherit 10 million displaced customers at zero acquisition cost. Regulation did not shrink the market. It handed the market to whoever could afford the license. 4. Hardware wallet maker SafePal disclosed a breach. A flaw in an order tracking plugin exposed nearly 40,000 customers. Names, emails, phone numbers, shipping addresses. Keys and seed phrases were not touched, so no funds moved. But think about what leaked. A list of people who provably own crypto hardware and where they live. The device secures your coins with math. The company that ships it secures your address with a plugin. Self-custody's weakest link is no longer cryptography, it is logistics. Bitcoin at 63,000, fear and greed at 30, and the smallest fund on Wall Street just got carried out. In a bear market, scale is the product. That's crypto today. The bond market just raised the price of trusting America. 1. The 30-year Treasury yield topped 5.31% Monday, the highest in 19 years. That number is the price of America's long-term promises, and it anchors your mortgage, corporate debt, and every data center loan in the AI boom. What is pushing it? Oil near $88 on the Iran standoff, and a Fed that is openly split. July's vote was 9-3, with 3 members wanting a hike, not a cut. The minutes drop Wednesday afternoon. The short end belongs to the Fed. The long end just voted no confidence. 2. 50% tariffs on Canadian goods take effect Wednesday, and Monday's talks in Washington did not close the deal. Canada's trade minister walked out saying, quote, "Our job is not yet done. Steel, aluminum, lumber, and autos employ about 2.6 million Canadians. Autos already pay an effective 12.5%. Whatever side of the border you live on, a 50% wall on the largest U.S. trading partner reprices cars, lumber, and groceries, and it lands weeks before an inflation print the Fed's hawks are already watching. 3. This week, the American consumer testifies. Home Depot reports this morning. Target and Lowe's on Wednesday, the same day as the Fed minutes. Walmart on Thursday. Consumer spending is roughly 70% of the U.S. economy, and these 4 ledgers are the ground truth the surveys cannot fake. Watch same-store sales and guidance. Home Depot tells you if big renovations survive these mortgage rates. Target tells you if discretionary spending is alive. Walmart tells you if people are trading down to survive. The bond market already voted. Now the cash registers vote. The 30-year at a 19-year high, 50% tariffs a day away, and America's 4 biggest retailers about to testify on the consumer. That's macro today. The AI economy ran on trust this week. Twice, the trust broke. 1. Nvidia just agreed to guarantee up to $105 billion of OpenAI's lease and power obligations per an SEC filing. The building, a new 8-gigawatt campus in central Ohio, built and owned by SoftBank's SB Energy, first capacity in 2028 on a 10-year OpenAI lease. If OpenAI cannot pay the rent, Nvidia pays it. Jensen Huang rejects the circular financing label. Quote, OpenAI will pay the lease, maybe, but the world's most valuable chip maker is now underwriting the credit of its own biggest customer, so that customer can keep buying chips. 2. GitHub went down worldwide Monday for more than 3 hours. The site, code review, automated deployments, and Copilot all impaired for a platform with 225 million users. Downloads failed about half the time at the peak, by Microsoft's own numbers. No root cause disclosed yet. Here is the context that matters. GitHub's own CTO said this spring the platform needs 30 times its current capacity to handle AI-driven coding demand. Most of the world's software is built through one company's pipes, and the pipes are running 30 times too small. 3. An AI just approved the code that broke Snowflake. A command injection hole sat in Snowflake's public repository. GitHub Copilot reviewed the change and called it all clear, missing the critical flaw. Then a second AI, the security firm Wiz's autonomous Red Agent, found the hole, exploited it, and reached authentication tokens for Snowflake's internal systems. Wiz disclosed, Snowflake patched, no customer data was touched. Companies are buying AI review to replace security headcount. In the first marquee test, the reviewer missed the breach path, and the attacker that caught it was also a machine. The chip seller is cosigning the leases, the code vault went dark for 3 hours, and the AI code reviewer missed the hole another AI walked through. That's AI today. The biggest number of the day deserves the full story. Monday, in an SEC filing, Nvidia agreed to guarantee up to $105 billion of OpenAI's obligations for a single data center campus in Ohio. Not an investment, a guarantee, a cosigner on the lease. Here is the context in one breath. OpenAI has committed to roughly $1 trillion of compute build-out, far beyond what its revenue can fund. The gap is being bridged by its suppliers, and above all by Nvidia, the company whose chips fill these buildings. The timeline. September 2025. Nvidia announces plans to invest up to $100 billion in OpenAI as part of a 10-gigawatt partnership. That is when the phrase circular financing enters the debate. Through 2026, capital rotates out of everything else and into AI compute. This year, SoftBank's SB Energy becomes OpenAI's build and own partner for US sites. And Monday, the Ohio campus. 8 gigawatts of computing on 10 gigawatts of new power generation, partly on federal land that once enriched uranium for the atomic age. First capacity in 2028, 10-year lease, 35,000 construction jobs, and behind it all, Nvidia's signature on the guarantee, plus $1.5 billion invested in SB Energy directly. Now follow the chain with me. OpenAI signs a lease it may not be able to pay. SB Energy borrows billions against that lease to build. Lenders accept the risk because Nvidia guarantees it, and OpenAI spends the money it did not have to raise on Nvidia chips. Jensen Huang says the criticism misses the point. Quote, OpenAI will pay the lease. If AI revenue shows up on schedule, he is right, and everyone in the chain wins twice. But a guarantee only matters in the world where it is needed. In that world, the chip seller eats its customers' rent. At the exact moment, its chip demand disappears, while the bond market is already charging the highest long-term rates in 19 years. Who decided all this? 2 CEOs and a filing. Who pays if it breaks? Nvidia shareholders first. Then everyone holding the AI trade. Watch the cosigner, not the tenant. So here's the question I keep coming back to. If Nvidia has to guarantee OpenAI's rent for the AI economy to keep growing, was the demand ever real? Or is the world's most profitable company paying to keep its own best customer alive? Tell me what you actually think in the comments. I read them. Blue pill. This is how big things get built. The strongest balance sheet absorbs the risk, weak funds die quietly, and the system works as designed. Red pill. The risk never disappeared. It just moved up onto balance sheets so large that if one breaks, it is everyone's problem. $105 billion says somebody had to cosign. Decide for yourself what that signature means. The timeline keeps moving. We will see you in the next one.